Uh, Good morning, everybody, or good afternoon, depending on what time you're watching this recording. My name's Justin Charlton-Jones. I'm one of the coaches in the No Limits community, and I'm delighted to be able to tell you that this morning we have Jenny Thomas, who is the founder of Nutshell Accounts, who's going to be talking to us about how to manage your cash flow, get more cash in your business, and keep more money away from the tax man as well. So, good morning, Jenny.
Good morning.
So the first area I wanted to talk about, also to ask you some questions about, is cash flow. We were actually doing a webinar on Monday in ActionCOACH, looking at the stresses that business owners experience and how to turn those into success. And the thing that comes through as causing the greatest stress to business owners is cash flow. And I know that this is a topic very close to your heart. So what would you say to business owners about managing cash flow?
So there's a couple of really important points around cash flow. So there's planning and forecasting, which I'll go into in a bit more detail. But there's also knowing how much money is in the bank and having that money almost just apportioned, ready to go to the various places it needs to go. So you don't actually. I have some business owners who, when they come to me, they literally have their bank account. They don't know what their profit is or anything else. They literally just work off their bank account. They're like, well, I've got that much money in the bank, so it's fine. I'm like, well, no, because what have you actually got coming out? So when's your next VAT due? How much of that money sat in your bank account is actually supposed to go to the taxman for corporation tax or VAT or PAYE? Or how much do you have to pay your salaries at the end of the month? Have you actually got enough money to cover all of this stuff in the next couple of weeks even? And a lot of people live sort of hand to mouth, don't they? They're sort of, I haven't got time to look at that, but things usually come right in the end, or you have to go and chase that large invoice that hasn't come in yet at the last minute so that you can pay your salaries. So it's all about planning and knowing what that money that is sat in your bank account at the moment is there for. And one of the biggest tips that I've got for business owners, and I think lots of people talk about this now, is putting aside a portion of every bit of money that you get into your business. So each month every time you receive a large invoice into your bank account, just put 30% of it into another pot. Just move, and there are lots of bank accounts that I think Metro Bank do it, and maybe Starling Bank do it. You can have little pots of money. So it's not even a separate bank account, but it's a pot, and it's set aside, and that's your VAT and corporation tax pot, so that it's never a surprise. So I have some clients who do this, and when I then do their corporation tax at the end of the year, they go, oh yes, no, that's fine, because I've got X amount in my pot. So that's actually quite nice. It's a little bit less than what I had in my pot, so I've got a bit of money back. Yeah. And the ones that don't do that are like, but how am I supposed to find £10,000 for my corporation tax? You have made that money, you've received that money in, put it aside, have it ready to pay the taxman. And the VAT point as well is like, well, actually VAT isn't yours. So put aside that money, because you should never ever see it as yours, because it's always got to go back to the taxman after at least, between 30 and 90 days later. So, it's don't bank it as yours, put it aside. So that's one.
Sorry, just a quick question, Jenny, because yeah. I have to say, listening to that description, I've come across several businesses who have had precisely those issues where they've got to the end of the financial year, they've got to the time when corporation tax is due to be paid, and they've told me, oh my God, my accountant has just said I've got to pay this much money in corporation tax, and it's due next week, and they have literally had to beg, borrow, and steal to be able to pay their corporation tax on time. So you mentioned 30% as an amount to put aside from the billings that come in. Is that, do you think, the ideal amount?
So I find that it's about the right amount for most businesses. I think you should always talk actually with your accountant to work out, you can sort of work out and guesstimate your own position. So it will slightly depend on what type of business you are, so that what VAT rate you are. So if you want to split them down, I usually say about 15% for your corporation tax, because the tax rate was 19%. I mean, that probably now needs to increase a bit if you're making large profits. Anything over 50k in profits, obviously your tax is going to go up now. But it allowed for deduction of expenses from your income. And then the VAT, the same thing. But the VAT point, you could end up actually needing a little bit more if you don't have very many VATable expenses that you can reduce the VAT bill with. So it depends on the type of business.
Yeah, and I'm assuming that because you're all over this, that your clients all get warned well in advance what their liabilities are likely to be.
Yes, I do. I try my best. So, but this always depends on the clients providing me with the information that I need in a timely fashion. So for my clients where I do their books on a regular basis, as long as they're keeping everything up to date, we can do their year end pretty quickly after the year end, as long as they're responding to my queries. But yeah, the idea of, you know, getting your corporation tax liability a week before you have to pay it is must feel horrible. However, the business owners should be going to their accountants sooner than that and saying, but why can't I have my liability yet? You know, give me my numbers. Because once you've gone past your year end, give it a month or so to allow for any adjustments, any late things coming in. Really, you should be able to then do your year end accounts and sort out your corporation tax and then plan for it.
Yeah. Okay. And any other advice on managing cash flow?
Yeah, I mean, the other point is a cash flow forecast, and that is putting in all of the outgoings that you know you've got coming up in the next. I normally look at a 12-week period, so it can be a really simple spreadsheet. Mark on it all the things going out, mark on it all the things that you've got coming in, the invoices coming in, and then the key point actually is making sure you're getting that money in. A lot of the time when I speak to people who are struggling for cash flow, it's because they're not getting their invoices in on time, or they're not invoicing quickly enough. If you don't invoice people, they're not going to pay you. So get your invoices out and chase them so that you can pay your outgoings without struggling. Yeah.
And I think payment terms, I appreciate you're an accountant and not a solicitor. But one of the things that I think frustrates a lot of people is that some small businesses might issue invoices and their terms of business are payment on receipt, for example, but the business they're invoicing might have their own terms, which are payment in 30 days, for example, and quite often payment in 30 days at the end, from the end of the month in which they receive the invoice.
Yeah. So
is there anything you can do about that? I don't know.
So I mean, no, I'm not a lawyer, but I would say if you're getting people to sign a contract for your work, and you've got your payment terms in your contract, I've got my terms of business, which has my payment terms in it. Make sure all of that is crystal clear before you start, to be honest, and then you can just start chasing. As soon as it's late, you keep chasing, don't you? And you know, and if they say to you, oh no, our payment terms are this, you say no, but you signed a contract that said that our payment terms are this, and it should be on the person who's provided the service who sets the payment terms, not the customer.
Yeah. And I think that's actually, you've just raised a really good point there, which is whatever size your business, you should issue a proposal or a formal quote to your customers, and you should include within that your terms of payment, because even they don't have to sign it, provided you've sent through a proposal which has your terms of payment in. If somebody then asks you to carry out the work, if they want to buy the services or the products from you, they are implicitly accepting the terms laid out in the quote or the proposal that you sent to them.
Exactly.
Yeah.
And it means that everyone's clear up front as well, to be honest, and you can't fall back on, oh, I didn't know.
Yes.
Yeah.
Yes. You mentioned cash flow forecasting there, which is very important. The other thing that I'm very keen on is budgeting.
Yep.
And I'm assuming that's another area that you're also equally keen on.
Yeah, in an old life, in my employment, I was the financial planning manager in various businesses. So budgeting and forecasting is definitely my bag, and it's just so key to a business. So I always try and explain to people though that it's very different. A 12-week cash flow forecast is very different to your budget, which is very different to your forecast. So your budget should be set at the beginning of each year. And it's, generally a monthly budget, I would say. And it's, what do you want to achieve this year? What are you trying to? And it should have some stretch targets in it, because I'm sure you always tell your clients, Justin, what do you want to achieve, and then stretch it a little bit, right? And then a forecast is something that you look at as you go along, and you sort of update that budget to actually see where are you actually going to land by the end of the year, and then you can compare that to the budget. And I like to do it 3 ways. So I look at both the P&L, the balance sheet, and the cash flow, because the cash flow can fall out of all of the stuff that you're doing on the profit and loss and the balance sheet, which then means that you can actually see if you're going to run out of cash at any point. And that's a really important point, because then you need to plan, and you need to look back at your profit and loss and say, what have I done wrong here? I can't do that expenditure there. I'm going to have to shift it. So it's all about planning, really, and not just winging it as you go along in business.
Yeah, and I think that's a key point, because I think what a lot of business owners don't understand about budgeting is that, first of all, it's actually about setting goals.
Mm-hmm.
Should be an integral part of your planning process, because once assuming that you have a financial goal within as one of your objectives, either an increase in revenue or an increase in profit or whatever it might be. First of all, you can't keep track of that if you don't know how much profit or revenue you should have generated each month to then compare against your actual P&L. But more importantly, as you've just said, there is the issue of the costs within the business. So if your business is growing and you know that you need to take on, for example, 2 new members of staff during the course of the year, you need to be budgeting for those additional costs within the business. And if you put your budget together properly, that will then demonstrate to you how much more revenue you need to bring in order to maintain your profitability with these additional costs, let alone to actually grow the profit within the business. And without a budget, how does, as a business owner, it's very difficult to actually know what level of revenue you should be attempting to bring in each month, and indeed whether the actual revenue you generate is sufficient to keep you on track for the goals that you've set.
Yeah, and I think in that example as well, with bringing on new staff, you can also see, so you will have it in your budget when you want to bring them on, but then when you're doing your forecast, you're like, well, actually, I haven't got to that revenue point yet, so I don't need to bring them in yet, because you should know at what point you need to bring them in. But then you can plan ahead and say, okay, well, I'm going to shift it back. But then also, to your point, whether or not you can cover the extra cost, you do quite often see that sort of every time you bring on someone new, because you're growing, you do see a slight dip and then a rise again. But you will see, whether you can actually sustain that. So whether it's actually achievable. So
yeah, absolutely. So yes, we've ended up with a sort of holy trinity here of the cash flow forecast, the budget for the year, and the P&L, all of which are integral to understanding what the business can and cannot do, and whether there's actually enough money in the bank to pay for the things that you want to do, let alone the necessities like your staff and your tax liabilities.
Yeah. So it should always underpin your other goals and plans. You need the financial plan to go and underpin it all, don't you?
Yeah.
But I am biased, you know.
Absolutely, but I'm sure, yes, I'm sure your clients are all, assuming, of course, that they, as we know, as a coach and an accountant, not everybody always does what they're supposed to do, but
no, you can preach it all you like, but they don't always listen.
But yeah, in an ideal world, they should have a budget, they should have a cash flow forecast, and all businesses should have a P&L to really be able to understand what's going on financially in the business. And at the end of the day, the two most important aspects of anybody's business are the finances and their marketing activity, because those are the two that enable the business to grow. Is there anything else that you wanted to say about budgeting and forecasting? Otherwise, I was going to move on to how to keep a little bit of that money that we've just been talking about making from the taxman. So I know that you're keen to make sure that people use all of the allowances, for example, available to them.
Yeah, I think there's some misunderstandings around, you know, what you can claim in your business and what you can't claim in your business. And there's two parts to that. So there's one, which is if the expense is not related to your business in any way, is not assisting your business in any way, it's not going to be an allowable expense, right? It shouldn't be in your business and will not be allowed for tax. And actually should really go against your director's loan account, which we can come back to. But then the other point actually is HMRC have what they call allowable expenses and disallowable expenses. So you can have things like entertaining, for example. If you entertain clients, as a lot of people do as part of their marketing, it's a business expense, isn't it? You're going out, you're meeting clients, you're whining, dining them, trying to get them to give you more business, raising your profile. But HMRC don't allow that as a deduction for your corporation tax. However, it is still worth putting it into your business as a business expense. Have the business pay for it. Because if you pay for it personally, and this is the bit people don't necessarily get, if you pay for it personally, then you've effectively taken that money out of your company, you've paid your income tax on it, whether that be on dividends or whether that be on sort of income tax, PAYE, and then you're paying for that meal out of your net income. You can pay it through the company, you just don't get a corporation tax deduction for it, but you then don't have to pay all of the income tax on it. Does that make sense? So it's still worth doing, it's still a business expense, but not for corporation tax.
Yeah, no, that's a very important point, that obviously, yes, anything paid for out of cash that you've taken from the business has already been taxed. And as you said, and once it's come out of your personal account, there's no way you can allocate that to the business.
Yeah, so there's that point. There are a lot of expenses though that are allowable through your company, and I'm not a financial advisor, so I usually direct people to a proper financial advisor, but there are a few key expenses that should really be going through your company that can really help you reduce your corporation tax. And the one is personal pension contributions, or other company pension contributions. So if you are a director wanting to plan for the future, you've made large profits in your company in the year, have you got a company pension plan going through your company? Because that's fully deductible for corporation tax. Again, it doesn't need to go to you personally. It can literally go straight into a pension pot for you for the future. No tax impact at all. It's a no-brainer. Then the other thing is there are some sort of insurance, sort of life plans and things which can also go through your business, a relevant life insurance plan. But that's one to talk with your financial advisor about. I never set any of these things up. I just tell people they should do it. It's a good deduction for corporation tax. And then the one that I tend to talk to people about when they're getting towards their year end, when they've probably made a bit more profit than they wanted to for corporation tax purposes, I talk to them about any capital expenditure that they might have been planning in the next few months. So there's no point just spending money for the sake of it. I mean, just to reduce your corporation tax, okay? That's not going to improve your cash flow. Always think about the cash flow as well. However, if you were about to go and invest in some capital items for your business, so I have cafes and things on my books. Sometimes I'm like, are you about to go and buy a new coffee machine? Has happened in the past. They're like, oh yeah, I was going to buy a new coffee machine next month. Like, okay, can you consider buying it this month? Because once you buy it, that capital allowance, you can get the full cost of that item against your corporation tax in that year, in the year that you buy it. So it can help in, smooth the corporation tax over time. And there are also some sort of super deductions at the moment where you get an extra 30% of the cost of the item against your profits for corporation tax, so it can reduce it.
Okay, and how? And just out of interest, how easy is it for business owners to find out about these allowances? And is it something that they can find out online or through HMRC, or should they just talk to their accountant?
The easiest way is always going to be talk to your accountant. It's all online. It is all online on the HMRC sort of website. So you can search for, do a Google search for allowable expenses in my company. There are things out there, but if you have an accountant, your accountant should be flagging these things to you anyway. We tend to, when we're doing the bookkeeping for our clients, we will quite often come across things that they're like, no, sorry, that's not allowable, that's not a business expense, and we talk to our clients and tell them, and we move it. And most accountants will be doing that, and you'll be being told when something's not suitable as a business expense.
Yeah, okay. No, it's always that's an issue that I come across quite a lot, and obviously I'm not an accountant myself, so I do tend to refer my clients to their accountant, but I'm frequently being asked, oh, can I buy this and put it down on expenses? Can I get the company to buy this or that? And
sometimes the answer is yes. Again, my main rule is it actually being used by the business? So you need to be a bit careful, because there are things like cars and things. People are like, well, can I just put my car lease through the company? It's like, well, you can, but if there's any personal use on it, then you end up with a taxable benefit on yourself. So it's actually not really worth it in most cases, unless it's being mostly used for business.
Yeah. Right. Okay. Now, another area I wanted to ask you a question about is how to actually take the money out of your company in a tax efficient way, because we've talked about the importance of monitoring the money in your business, why you need to have a budget, a cash flow forecast, an accurate P&L. We've talked about expenses as a way of offsetting some of the costs that your company might incur. But when we come to the end of the year and we can see that there's a certain amount of profit that's been generated, and we've got a lump of cash that's sitting in one of those pots in a bank account, what's the best way for a business owner to then actually get their hands on that money?
So, as I'm sure you know, there's two ways really to take that money out of the business. Well, maybe three, but the main two ways are as PAYE income or as dividends. And historically, it always used to be best to take, up to your personal allowance in salary and then pay the rest in dividends. It's now getting a bit murkier. So the corporation tax rates changed this year to introduce this step change between 19% and 25% for profits between 50,000 and 250,000, which means that when you get to the point where you're going to be spent, like, basically dividends are not allowable for corporation tax. So if you take dividends, you pay a lower rate of tax, you don't pay any NI on it. However, you do have to pay the corporation tax on it as well.
Yeah.
Whereas if you take the salary, that's a deductible expense. The corporation tax, you're not paying corporation tax, but you are paying employers NI, employee NI, and income tax. So it's actually become a bit of a complicated calculation to work out at what level do your profits should you no longer be taking dividends. So actually it's now almost reached a point where you have to speak to your accountant and say, okay, I look like I'm going to get profits of this much this year. How much should I take in salary versus how much should I take in dividends? Because it's no longer a straight answer of, yeah, just take your basic salary, up to your personal allowance. It's more complicated than that. If you're a small business, effectively, if your profits are less than 50k, it's still that straightforward because you're paying 19% corporation tax.
Yeah.
If you're in between the 19% and the 25%, it's a bit more murky. If you're above the 25%, then, to be honest, you're better off just taking salary.
Okay, which is why I suppose it comes back to the very start of this conversation. It's absolutely essential to have a budget, an estimate of the level of profit you're expecting to generate.
Yeah.
Because that will then determine whether you take salary or whether you take dividends. Yep.
At least you can plan for it, can't you? Otherwise it becomes quite complicated to unpick. But then again, the other point was that I again already mentioned, actually putting some money into your pension at the end of the year is also a good plan if you're wanting to reduce your profits below that 50k threshold.
Absolutely. And yes, a quick shout out for pensions. I know that they're getting more and more taxed. I have to say, the government have destroyed the pension system in this country over the last 20 years, but that's another topic. However,
that's for another day.
It is, but nevertheless, it is still one of the most tax efficient ways of saving money. And of course, what people don't often realize is that once money's in a pension, not only can you then draw down on that money when you reach your appropriate retirement age, but of course pensions can be passed on to your family. Yes. And are outside of inheritance tax. So, but anyway, but that's a separate topic.
That's a separate topic. You'll need to talk to someone else about that.
I'll invite a financial advisor along for the next few sessions where we can investigate that. Great. Well, we've come to the end of the half hour. Thank you very much.
You're welcome.
Thank you, Jenny, from Nutshell Accounts, for all your advice on how to get more money in your company and how to take it out efficiently. And I hope to have you again onto the Munch and Learn sessions again at some point in the future. But thank you very much for joining us today.
No worries. Thanks for having me. Thank you.
Okay then.
Bye.
Bye.